Hi everybody, we are from Group 3 and welcome to the presentation of our project on life insurance analysis. In this study, we are going to address three key questions. First, compare the whole life and term life insurance based on some key features. Next, we conduct a financial comparison of these two types of insurance through detailed calculations. Finally, we explore their application in real-life scenarios. Without any delay, let's dive into the insights and findings.
What is whole life insurance? Whole life insurance is a type of permanent life insurance that provides coverage for the insured entire lifetime. It provides both a death benefit to beneficiary no matter when the policyholder passes away and as a saving component. As long as the policyholder pays the premium, the policy remains active throughout their lifetime. For premium structure of whole life insurance, the cost remains unchanged throughout the life, and the coverage duration is the insured entire lifetime. For the cash value, it pays over time and can be borrowed for personal or emergency expenses. And the loans have lower interest rate, but we can reduce the debt benefit if not repaid. And lastly, we have debt benefit. It will pay out to the beneficiary after the policyholder passes away. The advantage of whole life insurance is it has cash value accumulation, which is a portion of the policyholder premium goes toward building a cash value and can be borrowed against or withdrawn. Next, fixed premiums. Premiums are generally fixed and predictable, allowing for easier long-term financial planning. And the guaranteed death benefit. The death benefit amount is fixed and guaranteed as long as you pay your premiums, providing financial security for the insured beneficiaries. And lastly, we have lifelong coverage, which is the whole life insurance provides coverage for the policyholder entire life as long as premiums are paid. But the disadvantage is the higher premiums, which is whole life premiums are significantly higher than those for term life insurance, making it less affordable for some individuals. Next, long-term commitment. Whole life insurance is a long-term financial commitment. Those who want to take this insurance is advised to think carefully. Non-impact. While the insured can borrow against the cash value, unpaid loan and interest reduce the debt benefit. And lastly, whole life insurance is not always necessary. For those with temporary financial responsibility, term life insurance might be more suitable than whole life insurance.
Now I would like to explain the term life insurance. Term life insurance is an insurance policy that provides payment of a benefit if the person suffers the life accident in a specific period. And this insurance usually purchased for a particular period only. The policyholder will make regular payments or premiums to an insurance company that receives a determined coverage as the primary benefit. And this policy will be expired and will not be used again after the end of the term. Now I would like to explain about the key features of the term life insurance. The premium payable structure for the term life insurance is level premium, which is the cost remains unchanged for the duration of the term, but the value of the premium will be reduced after the end of the term. The coverage duration for the term life insurance is temporary for specific limit period such as 10, 5, 10 or 20 years. The term life insurance does not offer any cash value because it is designed solely for coverage during the policy term. Premiums go entirely toward providing death benefit protection with no investment or savings component included. The death benefit of the term life insurance is provided if the policyholder passes away while under the policy stipulations. The death benefit will be provided until the end of the term will be achieved. Now, I would like to highlight the advantages and disadvantages of the term life insurance. First, the main advantages of the term life insurance, which is it offers low and affordable premium payable for those who cannot afford the higher value of permanent life coverage. The flexible term life insurance also allows the policyholder to determine the time payable and estimate how much the premiums they will be paid over the entire term. This policy is also very customized for growing families to maintain the coverage until the children reach adulthood. And this type insurance provides a large death benefit and relatively payable that supports the financial cost for the beneficiary. Well, the main disadvantages for the term life insurance, which is it does not offer the cash value that can be applied while you still alive. This insurance only provides temporary cover for a specific policy term, and which means it will expire at the end of the term, which is unable to be used. Term life insurance differs from whole life insurance, which does not have an investment component, which means the premiums are not invested in stock or bond in dice and responsible in financial growth strategies. Since the premium value will increase depending on age, the payment value will be higher to purchase the policy at the end of the term due to the health factors that will occur with age in a group of young individuals.
Moving on to question 2, we have used data from the Alliance Everly Plus policy to bring practical insight into the discussion for the whole life insurance. And based on the question given, the insured is 35 years old and the coverage amount is 500,000 ringgit Malaysia. The monthly premium for this policy is 580 ringgit, and noted that 8 ringgit Malaysian will be charged monthly for this plan. Hence, the annual premium will be 6,120 ringgit Malaysian, equal to 510 ringgit monthly. So using this info, we can calculate the total premium over 20 years, which is 122 and 400 ringgit Malaysian. So whole life insurance build cash value over time. Therefore, by assuming 3% annual growth rate, cash value over 20 years will become 164,446 ringgit and 69 cents. And by subtracting it with the total premium over 20 years, we will get the cash value growth over 30 years, which is 42,046 ringgit and 96 cents. This graph represents the premium, cost, and benefit growth of whole life insurance for Alliance Everly Plus over 20 years. It highlights three key aspects, which is the blue bar show the cumulative premium paid by the policyholder for over 20 years, and we can see that it increased linearly, which means the policyholder is consistently paying a fixed premium amount annually, while the yellow bar, which is on top of the blue bar, represents the cash value of the policy. The cash value grows gradually as premiums are paid and investment made by the insurance company generate returns. We can see around the 10 year, the cash value grows significantly, which means the policy starts building up a good amount of saving or investment returns. The last one, which is the orange line, indicates the total benefit, which includes the sum of the cash value and the insurance coverage. So over time, the total benefit grows at a faster rate compared to the premium cost, and cash value due to the increasing value of the insurance protection. And by the end of 20 years, the total benefit significantly surpasses the total premium paid. And this graph emphasizes the dual nature of a whole life insurance policy, which is providing insurance protection and investment or savings growth.
Next, for the term life insurance, we have chosen the plan Alliance Essential Cover, specifically Plan 500, which is a term life insurance option, providing a coverage amount of 500,000 ringgit for a fixed term of 10 years. It is designed to offer affordable protection tailored to the needs of young families. For a 35-year-old male, the annual premium for Plan 500 is 1,201 ringgit, while for a female of the same age, it is 983 ringgit. However, since this plan has a coverage term of only 10 years, we need to consider what happens after the policy expires. To calculate the total premium cost over 20 years as required by the question, the policyholder needs to purchase the same plan again at age 45 and pay a different and higher annual premium. At age 45, the annual premium rises to 2,756 ringgit for males and 2,101 ringgit for females due to the increased risk associated with aging. Based on these premiums, I have calculated that the total premium paid over 20 years. For a male, the combined cost of premiums at age 35 and 45 is 39,570 ringgit, and for female, it is 30,840 ringgit. This calculation assumes the same plan renewal after the first 10 years. One key point to highlight is that term life insurance does not include a casualty component. The entire premium is directed towards providing pure protection, which keeps costs lower compared to whole life insurance. This makes it a practical choice for young parents with significant financial responsibilities, such as mortgages or childcare. This graph shows the premium cost of term life insurance for the plan RSI Essential Cover, specifically Plan 500 over 20 years for both males and females. As you can see, the graph consists of two distinct linear segments. For the first 10 years, the annual premium is constant at 1,201 ringgit for males and 983 ringgit for females, as indicated by the constant slope during this period. However, at the 10th year, the policy will expire. Hence, the policyholder needs to purchase the same plan again at an entry age of 45 years old. At this point, the premiums increase significantly to 2,756 ringgit for males and 2,101 ringgit for females due to the higher health risk associated with aging. Besides, the change in gradient at the 10-year mark reflects the increase in annual premiums. As policyholders age, the likelihood of health complications rises, leading to a steeper slope in the second segment. Other than that, throughout the 20 years, males pay consistently higher premiums than females, as males are statistically more prone to health risks.
For question 3, there are 3 situations given. From the given situation, we choose the individual to recommend either whole life or term life insurance is suitable for them. We recommend Alliance Eye Essential Cover, which is a term life insurance for the young parent. There are several reasons for choosing term life insurance for them. First and foremost, it is affordable monthly premium to pay. It provides financial protection at a fraction of cost compared to the whole life insurance. Example, they have to pay 1,102 ringgit per annum, while for whole life insurance it will cost 6,120 ringgit per annum. In addition, it also allows young parents to manage other expenses too. Second is, term life insurance covers families during critical years. It covers the most critical years when children rely on their parents' income. Example, a policy covering a father until age 65 ensures children are protected during their formative years. It also provides a substantial payout, 5,100, to ensure the family's financial future in case of any unfortunate death. Last but not the least, this insurance will allow young parents to focus on other financial goals like educational savings plan, house loans, childcare, and traveling.